Hello, everyone. Welcome to episode 1. Today we're going to be talking about investing and kind of the fundamentals. So, first off, we can't talk about investing without talking about risk because it's a pretty fundamental concept of it. Um, Obviously, the goal of investing is to increase your assets. You play to win, but there is a chance that you can lose, and so it's important to understand how each investment works. It's also very important to invest money you can afford to lose. If you look back to kind of the Great Depression, that whole stock market crash was fundamentally triggered by people buying stock on margin, which is where they would borrow money to put in the stock market, and it caused a collapse. So invest money you can afford to lose. Then this last disclaimer here, past performance is no guarantee of future results. You're going to see that on any investment product you ever look at. It's kind of the industry standard, and it just sums it up for you. So let's get into stocks here. Stocks are one of the two main asset classes, and stock investing consists of purchasing ownership in a corporation. You can buy a little tiny piece called a share, and they're bought and sold in a stock exchange. Now, a stock market index, that's going to be kind of a snapshot of the market as a whole. And so the two big ones for American stocks are going to be the Dow Jones Industrial Average, which is the 30 largest American corporations, and then the S&P 500, which is the 500 largest. There are also some mid-cap and small-cap indexes. The Dow and the S&P are going to be the two big ones, though. Now, stock market, it's much higher risk, much more volatile, but historically it has given higher returns. Historically, it's been the most effective investment vehicle for long-term growth, and it has been pretty much unbeatable. Again, it's important to understand the risk component. Just because it's historically been that way does not mean that it's always going to be that way, but it's likely going to continue to be a effective asset class. Now we get into dividends. So dividends are kind of the way that stocks can generate income. So most corporations distribute their profits to shareholders in the form of dividends. So they get their profits, and then since you technically own your tiny piece of the company, you get a tiny piece of the profits. They're paid out quarterly. Usually it's not a ton. It's between about 1 and 5%. For example, here, Bank of America, their annual yield is 2.13%. Now, a dividend reinvestment, it's also called a DRIP. That's a very common function that you can set up on your investment accounts, where basically any dividends you earn, they just roll over into purchasing new shares. And so that's kind of where you get compounding in your investments, which we will address later. And now if a company is less attractive, they can use their dividend yield to attract buyers. So here we've got Ford and Macy's, which are two very unattractive companies from a growth perspective, as they've both been hurting tremendously lately, and they have well above average dividend yields to kind of attract those investors. Now we get into a recent history of the stock market. So in the financial crisis of 07-08, there was kind of a global economic recession. The stock market declined in what's called a bear market. So the Dow lost about 50% of its value in a little over a year, and people were freaking out. People were thinking the floor was going to fall through. Then the market hit rock bottom on March 6th, 09, and since then it's experienced a 10-year bull market, which so a bear market is a downturn, a bull market is an upturn. You'll hear that a lot if you ever open up the Wall Street Journal. You'll definitely see those terms. And so a little over a year ago, the Dow peaked around 27,000 points compared to the 6,000 it was 10 years ago. That's about a 400% increase. $10,000 invested back then would now be worth about 46,000. So you see, it's an incredibly lucrative opportunity in up markets. Now, at some point, the economy will enter another downturn, and it is very likely, almost guaranteed, that the stock market is going to suffer losses. So you have to understand that when you put your money in, that losses are part of the game. Now, during downturns, it is very important to remember that your losses are only on paper. So when you look at the stock market, you see that it's lost value. It's easy to freak out, but it's important to know that you haven't actually lost that value unless you sell your stocks right then and there. If you ride things out, the market recovers. So it's important to note that. And historically, over about the last 100 years, the stock market has been close to 7-year cycles, about 7 years of growth followed by a period of correction. At this point, we're kind of running on borrowed time because we've been going over 10 years at this point without any major correction, without entering a bear market. So now we're getting into bonds. So bonds are kind of the other major player in the investment game compared to stocks. And a bond is a debt security. So what that means is a corporation, let's say they've already issued their stock, so they've already sold the ownership of their company because they needed cash. Now let's say they need some more cash, so they can issue bonds. And what a bond is it's just like how a bank might loan you money to buy a house, and then you have to pay them interest back. Well, a bond is you're buying a corporation's bond, which is therefore giving them access to your cash for whatever the term is, which is the maturity. You'll see that word bolded there. So you can get bonds with maturity up to 30 years, and so then you get the annual or quarterly periodic interest payments, and then when the bond reaches maturity, you get the principal back. So here, you would loan $1,000 for 20 years, you get $80 a year, and at the end of the 20 years, you get your $1,000 back. It's pretty simple, and this is where bonds earn the term fixed income, because you know exactly the returns that you're agreeing to when you invest up front. There's really not a lot up to speculation, and so bonds tend to be a very safe investment with modest returns. So they're safe, but they aren't an incredible vehicle for growth. Now there are both corporate bonds and treasury bonds. Again, treasury bonds issued by the government. Corporate bonds are going to have a little bit higher interest rates because there's a little more risk. The main risk involved with bonds is if the issuer goes bankrupt, then they don't have to pay you back your money. So corporate bonds are a little higher risk because it's more likely that Microsoft goes out of business than the United States government. Now, current U.S. Treasury interest rates are between 2.5 and 3%. So that's really not a lot. And the interest rate on a bond is highly influenced by the associated risk. So U.S. Treasury bonds are about 3%. Greek Treasury bonds, whereas the Greek government is horribly unstable, you're talking 27%. So you just got to understand the risk-return relationship there. Now, the role of bonds. So they're definitely an important asset class, but you rarely see somebody that uses that as a primary allocation. They're more of a safety net. They're heavily used by institutional investors who need almost guaranteed investments, such as insurance companies, other stuff like that, banks. And so we kind of address the fixed income there. You know what you're agreeing to when you purchase a bond. And bond funds become very popular during recessions because bonds and stocks are not highly related. So when stocks aren't doing so well, that doesn't mean bonds are hurting as well. So they become more popular because they can stay somewhat stable. Now, mutual funds here. So the reality of investing is that the average person is not an expert stock and bond picker. And so most personal investors invest in mutual funds. And so mutual funds are managed by a professional asset manager for a fee. So basically you're giving your money to an expert, and you're paying him a fee to manage your money, and he's going to allocate it the way that he sees fit. Now these funds are split up into shares, very similar to stocks, and they're bought and sold. So mutual funds can contain equities, which is a stock investment, or debt, which is a bond investment. Or it can be a combination of both. If you look up any mutual funds, you will see these terms equities and debts. You will probably also see stocks, but these two are definitely important to know. An equity is going to be a stock investment, a debt is going to be a bond investment. Now, mutual funds make money, they profit through dividends, which we kind of already addressed, which is going to be the redistribution of their earnings, and then also capital gains, which is selling it for more than you bought it for. So essentially, these function the same way that stocks do. They're just a mutual fund instead. So now kind of continuing on, here's some of the largest mutual fund companies. You probably see these guys advertised quite a bit. Vanguard and Fidelity are going to be the two largest. T. Rowe Price, iShares, Mellon Capital. These are some good resources here to come back to. Now, you might look at this screenshot here. And so when you look up your mutual fund, so this mutual fund is T. Rowe Price Capital Appreciation. So this will be the one that we're using as our example here. And so we're using the, you see the price there is $30.03, and that NAV above it is going to stand for net asset value, which is kind of the comparison to share price for a mutual fund. And so as you see, this one went down a little bit today. Now it's important to look at the expenses here is 0.71%. So that means that every year, that means T. Rowe Price is going to take 0.7% of the money that you have invested with them as their fee for managing it for you. And then another thing to look at here is this minimum investment, and that's going to be $2,500. It's important to note that. So you have to put at least that much into their fund to invest in it. Now this is the asset allocation here on the right for the T. Rowe Price Capital Appreciation. And as you can see, this is kind of a combination of equity funds and debt funds. So you've got 65% in U.S. stocks, 26% in bonds. It's a little bit of mixture, some stuff in cash and foreign stocks as well. So now, how does investing really relate to you? Well, the big thing is retirement right now. So that has been shifted kind of from the employer when we used to have pensions. Now it's on the individual that you have to manage and you have to contribute to your own retirement account. So a couple different examples, we'll cover these in a minute here, are going to be the 401k, the IRA, and the Roth IRA. And now beyond retirement, investing is an incredible method for long-term growth. Really, if you can invest, you can make your money work for you for nothing. And it's pretty incredible the opportunities that can be sought through investing. So now types of retirement accounts. So the 401k is probably the one you've heard of, and that is sponsored by your employer. So it's a tax-deferred retirement vehicle, meaning that money goes in pre-tax, and then it goes into this account where you invest in mutual funds over time. At age 59 and a half, you can begin withdrawing from the account, and then when you withdraw it, that's when you're taxed. And so the idea here is that you'll be in a much lower tax bracket when you're retired than when you're at the peak of your career. And the thing about the 401k is that it can only be offered through your employer, and a lot of employers offer 401k matching, where like they'll say if you contribute up to 6% of your salary, they'll match it, which in that case, you're kind of giving yourself a 6% raise if you're contributing to it. So it's kind of a way that they incentivize saving for retirement. Now, traditional IRAs, this is going to be like a 401k sponsored by the individual instead. They function the same way. They're tax deferred, and then they're subject to tax upon withdrawal. Now, a Roth IRA is going to be different. And this came up in the 90s. Congress allowed this to be a thing. And basically, you put taxed money in there, so you're taxed up front, but then the earnings will be tax-free if the two conditions have been met there, which is important. And so really what these do is they shelter your investments from capital gains tax, because when you invest just on a personal level for your own growth that's not technically towards retirement, you're going to have to pay capital gains tax. And so these are supposed to incentivize retirement by creating benefits for that. And so there are maximum contributions because, again, it's kind of a loophole in the capital gains tax designed to encourage saving for retirement. And a lot of people talk to a financial planner or a financial advisor. And another thing to remember is this stuff is constantly changing. Congress is constantly changing their tax code. And so it'll be interesting to see what happens with this. So thank you guys.